Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Hello? Hello? Is this okay now? Yes, good. Finally, this one works. Hello, everyone. So this is the 5th lecture, and you do know you're going to have the quiz this week? Yes. So your quiz will be in your tutorial. So each tutorial attend, you will have the quiz. All right? So make sure you do attend. All right? Because eventually you will find every single marginal mark works. All right? Helps. All right? So make sure you do attend. And make sure you are self-disciplined. Then we just want to keep the system to be fair to every student. So make sure you just help yourself, don't help others. All right. That's just not fair to the other students and to yourself. Before we start the lecture, have you noticed my post on Walto regarding the mid-semester exam? Not yet. You please pay attention to Walto, because some important announcement I will always post onto Walto. All right, make sure you do check them. So actually, I'll post the exam information to Walto. Here it is. So if you go to course announcement, I think in your computer you can see from the right-hand side, right? And the May semester exam, can you see that? Yes, that's posted by myself, yeah. If you click the link, you can see I've actually, this information here. This is what, the exam venue and exam time, that's what I received. I know some of you may have different venues. Just check your own emails. I guess you all received some individual emails regarding the exam information, so check yours. This is what I received, all right? To help you with your preparation, please, yes, I uploaded some past exam papers. And those past exam papers, we are going to have very similar format, structure for the exam. You're going to have MCQ, you're going to have theoretical questions, you're going to have the practical questions. The format, the structure are very much similar to the past ones. And if you feel you may not have enough questions to practice, you can just download the exam paper and also upload the solution. Make sure you try to solve them by yourself, then compare that with the solution. See how it works, all right? And one thing you probably just be aware, some issues covered in previous exam paper may not be the topics we are going to cover in this one, all right, in this semester. So if you see something like growth method, it doesn't matter to us. All right, we didn't learn that. All right, and yes, just do what we have covered. And they may have some topic from capital, from the share capital, which we are going to cover in lecture 6. And you do know we only cover lecture 1 to 5 inclusive for your mid-semester exam. Is that okay? And for your quiz, lecture 1 to 3 inclusive. All right? For your quiz, this week's quiz. All right, is it clear? And our tutor kindly agreed to give some additional extra consultation time. Feel free to come for any consultation slots. To find one just according to your schedule, whichever available to you, feel free to drop by. And we are very willing to help you. All right? So make sure you do use the time and use the slots and make the best use of us. All right? During the break, so all the other normal consultation hours still run as normal. All right? So if you have some, if beyond those slots, all the normal hours still working. I will be away during the break, but not for next week. Just from the break, I will go to the Europe for a conference. So yes, if you have questions, I may not be able to address immediately or as soon as I can when I'm on campus. So if you need to have some information, try to review your questions now. Then don't accumulate all your questions until the end or until the last minute of the exam. I'll be back when you have your exam. So only during the break I will be away. I may not be able to respond to your emails as soon as I can when I'm on campus. But it shouldn't affect much of your study. I would assume I'm still reachable through emails, just maybe not that sooner manner to reply. Okay? So that's it. Some of you, if you need dictionary, just come to our school. Maybe any lecturer can sign your request for that dictionary. So that's fun, okay? So this is about the exam. Now this is this week's lecture. You know what we are going to learn from this lecture? Income tax. I know, to be honest, this topic would be the most comprehensive one in the first part. Oh, by the way, the lecture 6 is not going to be examined in your exam, mid-semester exam, but please still come to the lecture, okay? Because that one is going to be examined in your final exam. And to be honest, that is relatively easy than the other topics that's going to be examined in your final exam, okay? So make sure if you just spend 2 hours, then you can get it. Why not, right? Make sure you still come. You are absolutely encouraged. You're absolutely encouraged to come because then you probably spend less time for that exam, for your final exam. Lecture 7 is going to be the very beginning topic, the theoretical topic for all the following lectures. Okay, for all the following second part of lectures. Then lecture 7 is also important. However, you may notice the exam time is scheduled very just clashing with our lecture time. Have you noticed? So that was scheduled on Wednesday, 12:30, which will just clash. It doesn't always happen, but it happens this time. So it clashes with our lecture. I tried my best to get a slot for you to have this replaced lecture, Very unfortunately, because that week we have Monday and Thursday as public holidays. So we couldn't find out the venue, and the university is under construction. The only thing I can do is just upload the recording for lecture 7. Okay? So you know you have to listen to the recording for lecture 7. That's why I absolutely to suggest you to come for lecture 6 live here. Otherwise, if you listen to recording for 2 of them, that's too much. All right, just make sure you come for lecture 6 and lecture 7. You have to listen to the recording. I guess I will still be here to record everything on the time schedule for our lecture. If you can make part of that after your exam, no, before your exam, you can still come. But I guess, yeah, it's up to you. I will be here. All right, I will deliver the lecture and make the recording. But it's up to you whether you want to come or not. Okay? So, yes. Okay, so the income tax is the most comprehensive issues for the first half, to be honest. All right? So, I need your attention every minute. Okay? I need your attention. So accounting for income tax, why income tax might be a little bit complicated? We have learned everything accounting profit, tax profit, right? We have learned accounting. We know accounting profit, we know accounting expenses, accounting revenues. So that's what we have learned, right? But we have to pay tax for the profit that the company earns. How? If that tax is simply based on the accounting profit figure, which is coming from the revenue less the expense, that will be very easy for us. Okay, because we already got the accounting profit figure, right? Through whatever revenue you have, whatever expenses you have, that's accounting standard told us, right? So we know how to get accounting. Suppose we know, I know there's still a little bit of issue of understanding accounting profit. However, suppose we know everything about accounting profit figure. If the tax is just based on that profit figure times the tax rate, life is easy. All right? The complicated thing mainly coming from the tax profit. Because accounting profit is following accounting standard. We get revenue, we get expense, then we get profit. However, tax has their own rules. Accounting is mainly based on what kind of accounting? Accrual. The profit is, the revenue is always about this period. If you earn the revenue, doesn't matter if you receive the cash or not, right? The expenses is always accrued expenses. It doesn't matter if you really spend money for that expense or not. If you believe that expense is for this period's operation, then that's expense. Then you get accounting profit. Tax profit is mainly based on, do you know what? Cash flow. They mainly based on cash. Some revenue, we think, yes, we earn for this period as accounting. However, tax tells us if you haven't received that revenue, we don't charge you tax on that revenue. And some expense, if you have recognized as expense in accounting, but you haven't paid cash for that expense, they say, okay, you can't get tax deduction from this period. Okay? And this is the difference between accounting profit and tax profit. Not only to that kind of differences, some revenue will you never require to pay tax on that. Some expenses, you will never get tax deduction according to the tax law. So we will have some differences between accounting profit and tax profit. That one confuses a lot of the students, all right? But now you understand the basic rule. Basically, accounting, we have accrual accounting. Tax, we have the cash-based. That's the main difference between these two.
So first of all, when we do the income tax, we need to understand the difference between accounting profit and tax profit. Then we understand that tax profit we will have the differences, right? I'll discuss the two types of differences later, but you know we have differences between accounting and tax. And based on this difference, we are going to have the tax effect accounting. All right, that's the second subtopic. And how do we do all the accounting for these tax effects? We are going to rely on a worksheet that is called the income tax worksheet. Okay, so we will discuss the income tax worksheet. Do you remember the list we just finished? We just done? The list, we rely on the list schedule, right? So basically the income tax worksheet, you can treat it as some schedule as well. We have a way to figure out the difference and to recognize things. Then according to those numbers, we can do accounting. We can do our journal entries for this tax effect accounting. So that is about the income tax worksheet. Yes, then after we get the worksheet, according to that, we do accounting, we do journal entries. So that's it. Life could be more complicated because assume you are a big company this year, and next year you may become a small. Do you remember, if you become small, if you meet several criteria, you become small, and you might be applying with a smaller tax rate, right? So sometimes tax rates changes. If you have changes in tax rate, you may think, okay, for current year, I was 30% for all the previous year, and current year I might be entitled to have 25. So I may just use current year's taxable income times 25 to get my current year tax. All right. However, that's not that simple, because you do know we have differences in accounting in tax, right? And in current year, in previous year, you may also have that kind of differences. If in previous year you have that kind of differences, how do you record them in your accounting journal entries? And they will be shown in your financial statements, right? So when we have tax rates changes, all your previous year using the old one, the current year, following year using the new one. But the old one has impact on your tax, right? Current tax assets, deferred tax assets, deferred tax liability. I'm going to talk about what are they, all right? But you know it affects assets liability from your statement. Then we need to change them. We need to change them according to the new tax rates. So the new tax rates, if you have changes in tax rates, it may affect two things. One thing is for current year. All right, when you calculate current year's tax liability, it also affects your previous year if previously you have deferred tax assets, deferred tax liability. All right, so we will see how do we handle that. All right. Then the tax losses. You know, if you are a company always only generated losses, not for profit, the tax is just totally irrelevant, okay? If you always have losses, you don't need to pay tax on that, right? However, sometimes companies have profit, sometimes they have losses, right? If you have losses in 1 year, okay, in the past years, in the past 3 years or past whatever years, you are allowed to carry forward that tax losses. When we say carry forward tax losses, you can think about, okay, previous year you have 100,000 loss. Current year you have 200,000 loss. Profit, 200,000 profit. If you look at current year alone, you will pay tax on the 200,000, right? However, tax allows you to carry forward previous year's loss. Then current year you only need to pay 200,000 less previous loss 100. You only need to pay that much. So you can always use previous year's carry forward losses to cover current year's tax liability. Is that okay? So that's the topic we are going to cover. Okay, so here is the whole thing we are going to do. So basically, I'll give you the picture, and because when we are doing the details, sometimes you just get lost. Then come back to the picture, you understand what you are doing. Okay? And for the tax payment, so once we calculated everything, we know how much tax we need to pay, then you start to pay, right? Normally, the payment would be the quarterly payment. The tax authority allows you to pay for 4 installments. Okay, I'll show you later. Okay, so that's nothing complicated at all. So first topic we have is the difference between accounting profit and tax profit. Accounting profit, easy. We just get accounting income less accounting expenses. That's it. All right. Accounting income, accounting expenses, which is complying with the accounting standards, right? So if we follow in the standards, we will just accounting what kind of economic benefits we can recognize as income, we recognize. What kind of expenses we can recognize, we just recognize. Okay? So then we get the accounting profit. And this is based on accrual accounting, right? Accrual accounting. For tax, we have 2 new terminologies. They are very understandable from the name alone. Like we have the assessable income and allowable deduction. So basically, if you think about it, this is just equivalent to the conceptually, this assessable income is just equivalent to accounting income. What we mean assessable income, which means tax payable. Okay, you need to pay taxable. This assessable income, you can use another word called taxable. So this type of income, you need to pay tax on. Okay, that's the assessable income. But in tax, for when we calculating taxable profit, we call them assessable income. And for the expenses, some expenses, we may call them, according to tax, okay, profit, we call them allowable deduction, which is also understandable. If in future, when we calculating the income, the expenses always the kind of deduction from the profit or from the revenue, right? Are they also tax deductible? That's the concept from tax profit. Okay, so we will have some income. If they are taxable, then that's the way to calculate tax assessable amount. Okay, then we have some expenses. If they are tax deductible, then we call them allowable deduction. All right, by this way, the assessable income less the deductible, allowable deduction, then we get the taxable profit. Okay? And this is based on the requirement of the income tax legislation. Okay, that's not from the accounting standard. So generally, this would be the cash flows, as I explained. Okay, so accounting mainly accrual based, and the tax mainly the cash flow based. There would be some exceptions. The tax may not be based on cash flow. I will explain to you. Okay, but the general rules would be accrual accounting, cash flow tax. Okay. Yes, the problem is if the assessable income always equivalent to accounting income, then we would have no complicated issues, right? However, sometimes assessable income is not equal to accounting income. For example, we may have 2 types of difference between these two. One is called permanent difference, another is called temporary difference. So regarding the income, the tax way to calculate the taxable income would be different from the accounting way to calculate accounting income. And the difference between them could be two types. One is permanent, another one is temporary. The permanent one, think about some revenues. You may never be required to pay tax on that type of revenue. Okay, then you will generate some permanent difference. Okay, for some other revenues, you may not require to pay the tax for this period, but later on, you still need to pay tax on them. That will be the temporary difference. Is that okay? So that will be two types of differences. One is permanent. You will never do tax payment for this type of revenue. An example would be like government grant. If you receive a government grant, let's say 100,000 this year, in accounting you recognize it as the revenue. But in tax, they don't charge tax on that. Why? Think about the taxation. The taxation is in charge of is taken in charge by the tax authorization, right? Tax authority, ATO in Australia. They are the government agents, right? If on one hand, the government, another agent grant you 100,000 and tax authority, another government agent say, okay, you have to pay 30%, then they take 30% back. The government alone as a whole will actually just give you 70,000, right? Why would they bother to do something like that? So they will simply, exempt it from the taxation for the government grant. Okay, that's one type of revenue which actually generates the permanent difference between accounting profit and assessable income, tax income. Is that okay? So that's one thing. Some temporary difference could be just like the accrued revenue. If you have accrued revenue in this period in accounting, you do recognize it as the revenue, right? It increases your profit. Is that okay? So you recognize some, let's say, interest revenue receivable, right? So not yet recognized, but you do recognize the interest revenue by receivable, okay? But you haven't received that. Tax may say, okay, you don't need to pay tax on that this period. Pay it when they actually pay. That's cash base. Clear? So you have temporary difference. You are not exempted from paying tax on that for that type of revenue, but they just deferred it. Is that okay? So that's the temporary ones. For deduction, that's the same thing. We have two types of differences, permanent and temporary. So for some kind of expenses, they are never allowed to be deducted from your profit so that your tax payment will be smaller. Is that understandable? If you have expenses, normally we deduct that from accounting income, then we get a smaller profit, right? Then you pay less tax on it. Is that clear? But tax may say, okay, this type of expense, you will never get deduction. You do calculate like income less expense, then you get profit, then you pay tax on that. But tax says, okay, this kind of expense you will never be deducted. So you have to add that expense back to accounting profit to get your taxable profit. Is that okay? Raise your hand anytime if you don't understand. I want to go through everything slowly. I may repeat. So I want to make sure you understand them conceptually. Otherwise, you will not be able to solve the practical part. Is that okay? Anytime you feel you get lost, let me know. Okay? All right. So that kind of expenses will be permanent difference because you will never get tax deduction from that type of expenses. Examples are like fines. If you polluted the air or you polluted the sea and you get a fine from the government, they charge you 100,000. That's not the tax authority, might be some other environmental regulation authority, okay? So they charge you 100,000 and tax say, okay, tax authorities say, okay, you get 100,000, that's you show as some expense, some costs, right? And you deduct that from accounting profit, right? When we charge you tax, we base on that profit figure. However, tax says no, otherwise you will get 30% benefits. A fine is a fine, okay? That expense shouldn't be deducted. All right, so that will be the permanent difference. One example of that, okay? Entertainment expense is also not allowed to be deducted from this taxable profit. All right, and we also have some temporary ones as the expenses. You only don't deduct that from your payable tax from this period, but later on you are allowed to get that deducted. Again, that could be just accrual expenses, okay? Like if you have some provision, so you recognize, like for the warranty, okay? If you have provision for the warranty, you recognize as expense in accounting, and you deduct that from accounting profit. Then your profit figure is smaller, your tax payment will be smaller, right? However, tax says until you really pay, then we can allow you to deduct that. So in current year, you haven't paid that. Next period, you pay for that. Then next period, when cash out, okay, that expense can be deducted from your profit figure. Then you pay less tax. Is that clear? So that would be the temporary difference, okay? Yeah, here I give you some examples, see how accounting profit might be different from the taxable profit. The government grant I just mentioned, so in accounting, we normally treat it as revenue, right? But in tax, they are not going to be taxed. All right, so that will be not taxed. For the sales revenue, think about sales revenue.
When we sell products, we recognize the revenue, right? So when we recognize the revenue, do we always receive cash? You probably also learn some manual accounting, and they may give some discount in 1 month time, right? So anyway, when you have sales revenue, most of the time you probably won't have cash. You will recognize what? Receivable, account receivable, right? Actually, that's not the cash sale. That's the credit sale. That's the credit revenue. You haven't received cash, right? So in accounting, we do recognize it as the revenue. In tax, what shall we do? If the cash flow rules apply, we should not add it to taxable profit, right? However, this is an exemption for tax. For sales revenue, they basically will recognize it simultaneously as accounting recognizes it. The reason for that, just because sales revenue is kind of everyday operation, and that's the main revenue for a company. So if they do this exceptionally, then that will, if they also follow the cash flow rules, that's just quite messy, right? So sales revenue, credit sales revenue can still be treated as the revenue. Then you pay tax in the current simultaneously as accounting recognizes it as the income. Is this clear? Okay, that's about the sales revenue. That's one exemption because I just mentioned like most types of accrued revenue, like credit sale, that's one type of accrued revenue, right? Most of them will just apply cash flow rules. You pay tax when you receive cash. Sales revenue, exception. Okay, that's the exception. Clear? Are you all good? Yes.
Yes, for all the other accrued revenue, in accounting, we treated them as the revenue. But tax will typically tax them when the revenue received. Okay, then you see there is different, right? And for the revenue in advance, sometimes we may receive revenue in advance. Okay, somebody pay them before they get the product, right? That's the revenue in advance. In accounting, what do we recognize them? Liability, right? Because then you are obligated to pay them, to give them something, right? So that becomes your obligation. So initially you will recognize it as a liability. But how do you think we are going to do for tax? Tax is cash-based. Revenue in advance means you receive it, right? If you receive it, tax says, okay, pay tax on it. Okay? So that's the tax way. So you see the difference between accounting profit and taxable profit, all right? For all of our income tax, the starting point is always to adjust accounting profit to taxable profit. Do you see? Because we need to know the taxable profit so that we can calculate how much tax we need to pay. All right, so the first step of all the income tax is always starting with accounting profit. We adjust that to taxable profit so that we understand how much tax we need to pay. Clear? Okay, so for some expenses, also some examples. Like I said, the entertainment expense, the fines from some governments, they are not allowed to be deducted. So they are not a tax deduction. All right? But in accounting, what did we do? We recognize them as expenses. All right? And also goodwill impairment is not allowed for the tax deduction. Right? Remember, what did we do for the goodwill impairment? Did we do impairment loss tax? We have impairment loss. Then the first thing we allocate is to goodwill, right? When we deduct the amount of goodwill, we recognize impairment loss. So in accounting, that is expense, okay? However, in tax, no, they are not deductible, which means you get rid of that from accounting profit, you add it back for taxable profit. Clear? Okay, good. And many other accrued expenses, whenever these expenses occurred in accounting, what we do? We recognize them as expense. In tax, cash, paid. Okay, when they are paid, they can get deducted from tax payable. Okay, all right. And for the debt, bad debt, doubtful debt, they are all treated as accounting. But we understand that's just our estimation. We don't really get cash out, right, for those. But only when those bad debt actually happens, then you can get the tax deduction. All right, so that's all the consistent rules. And many prepaid expense. In accounting, when we have prepaid expense, like you prepay some insurance, what do? We shall recognize assets, right? Because you prepaid, that's treated as the assets, right? However, in tax, that's not expense yet, right? Maybe later on you will really have that insurance expense, but now not yet. It's an asset in accounting accounts. However, in tax, when you paid cash out, they are deductible for that period. Clear? All good? Depreciation. Depreciation is a little bit tricky because depreciation, that's the accrual concept, right? That's the accrual concept. So in accounting, we do have depreciation, and we have depreciation expense. It's deducted from the profit, right? For tax, depreciation, you never really pay cash out, right? Because you have already paid at the beginning, right? Or maybe through some mortgage or whatever way. Anyway, when you recognize depreciation, you don't really pay cash, right? However, tax allows you to have the depreciation deducted. However, it might be different from accounting way. You do know the depreciation actually is the accounting estimation. It's not accounting policy, it's accounting estimation. You may adjust the depreciation based on your estimation of the current situation, right? So that's the estimation. Tax may have different opinion on how you depreciate the assets. Okay, you may say, okay, this asset, I'm going to use it for 4 years. That's why depreciation is always about the carrying amount divided by 4. Okay, however, tax may say, okay, this type of assets, they should be depreciated in 3 years. Okay, then your depreciation expense would be different. According to tax, according to accounting, they are different. If they are different, we need to adjust them. Okay, we need to adjust accounting profit, and perhaps we just add depreciation expense recognizing accounting back to accounting profit and deduct the right amount that the tax allows you to deduct. Is that okay? So that way we adjusted the depreciation expense to the tax deductible ones. Okay? All right. And for development expenditure, in accounting, we often just capitalize them, then subsequently we have amortization, right? But for tax, when you really paid for this development expenditure, then they allow you to get tax deduction. In one way, you can treat it as the encouragement for the innovation. All right? So that's the accounting profit and taxable profit. Yeah, the government grant we have discussed. So when we have government grant, we have calculated accounting profit. And when we have this accounting profit, that will be higher or lower than taxable profit. Tell me, when we have government grant, we will have accounting profit figure which would be higher or lower than the taxable profit. Higher or lower? Higher, right? When we have accounting profit figure, that profit figure includes government grant. Agree? But tax says you don't need to pay tax for this government grant. So they will deduct that revenue. So accounting profit will be higher than taxable profit. Okay? So your actual tax payment would be lower than simply the tax rate times accounting profit. Does that make sense? So that's one example about the government grant. Yeah, let's look at the entertainment expense. When you have entertainment expense in your accounting profit, your taxable profit will be, accounting profit will be higher or lower than the taxable profit. When you have entertainment expense, your accounting profit figure will be higher or lower than the taxable profit. When you have entertainment expense, your accounting profit will be higher or lower than taxable profit. Will be lower because you deduct that from accounting profit, but taxable profit says, okay, no, this is not tax deductible. They will get it back. So accounting profit will be lower, right? If you simply use tax rate, tax accounting profit, that will be lower than your tax payable. Agree? So you would be able to see that in this way, right? So accrued revenue, yes, we have covered those. So you can simply have a look if you need more reflection later on after the lecture. So this slide, it tells us how do we get taxable profit starting from accounting profit. Okay, we add something, we deduct something. Okay, so the previous cases I've discussed actually is just the way to show you how to get something back, to get some expenses added, right? Which is not allowed for tax deductible in current year, we get them back, right? And some revenue, if that's not taxable, we deduct them from accounting, all right? So those things you can refer back when we have all the examples learned, okay, in a minute, all right? You can just come back. I would not recommend you to memorize, to force yourself to memorize them now, because if you try to force yourself to memorize them now, you probably won't get it, okay? But when you see all the examples, you need to know how do I make judgments. I'm not going to test you or give me the list of how do we adjust accounting profit to tax profit, then give me 1, 2, 3, 4, 5, 6. I will not do that because that's just doesn't really make sense, okay? What I require you would be when you see the expense, when you see the revenue, you would really know how to get them back to adjust it to taxable profit, okay? And this one will help you to understand, okay, when you see this all these examples, all right? Okay, let's have a look at this example. This company commences operation on this date and presents its first statement of comprehensive income, first statement of financial position. Yes, 1 year, right? The statements are prepared before considering taxation. So everything here is about the accounting, right? So we have the statement of comprehensive income, we have the statement of financial position, and we also have several pieces of additional information. Okay, so let's have a look at here. So mainly when we adjust accounting to taxable accounting profit to taxable profit, we need a lot of information coming from the statement of comprehensive income, right? Because that's mainly about the revenue expenses, all right? But sometimes we may also need the statement of financial position to get some numbers, all right? Mainly we will rely on this statement, income statement, all right? So if you look at the gross profit, that will be the accounting profit figure we start with to get the taxable profit, right? So that's the accounting profit figure. And then look at the revenue. We have government grant, then we have the expenses. Yes, so the problem here we have would be for some expenses, for some revenues, they should be adjusted to get the taxable profit, right? So if you look at them, at least we know government grant will generate some difference between these two, right? Is that temporary or permanent? It will be permanent. So you will never need to pay tax on that, right? And for some expenses, what we have learned for expenses, in accounting, we recognize them all as expenses. They are deducted from this accounting profit figure, right? They are deducted from this accounting profit figure. However, does the tax allow them to be deducted? What would be the rule to decide whether tax allow them to be deducted or not? Cash, right? Did the company really pay for it? We need to know how much of them actually got cash paid, right? Then the cash payment would be deducted from the tax purpose. Otherwise, that's just accounting expenses, may not be the allowable deduction for taxable profit. Okay, so we will see how it works. So how much the government grant, we are clear, right? What shall we do? When we have accounting profit figure here, we have accounting profit figure here, then we have government grant. How can we adjust this one so that we can get the taxable profit? We deduct that or we add it? We deduct it because this one actually contributes to the profit, right? And this you don't need to pay tax for. Okay, so we deduct this kind of revenue. Okay, for the expenses, they were all deducted from accounting profit, right? But we want to see how much cash they paid so that we can see that's the taxable profit, right? So only based on this information, we don't really know how much cash we have paid for them, right? So we may rely on additional information or this statement of financial position, okay? Because, for example, if we have some prepaid things, suppose this is 2012, if you have the beginning, come back, yeah. If you also have some beginning figure, and you have the ending figure, and you do know how much that's prepaid what? Prepaid insurance, right? And you do know how much the insurance paid. Insurance expense recognized in accounting. When you recognize insurance expense in accounting, you have deducted the insurance, prepaid insurance, right? So you would be able to figure out how much cash that is, right? Make sure you do understand. If you don't, you may need to go back to your prerequisite course a little bit to see how can you get out this cash payment for that, okay? In this example, actually you don't need to do that much. You have been given the figure from the additional information. In case if you don't have that information, you should be able to figure out how much cash you have actually happened. Okay, actually happened. All right. So, okay, so this is the additional information. Good news, all administrative expenses incurred has been paid. What does that mean? We don't need to adjust it, right? Because administrative expense in accounting recognized as expense, all cash paid, taxable deduction, okay? It's allowed for tax deduction, okay? So that's good. None of the long service leave expense has actually been paid. Even without the following sentence, we should be able to know if that's nothing has been paid. In accounting, you recognize as expense, long service over here, okay? In accounting, you recognize it as the expense, but it's not paid, which means that's not yet tax deductible. We get it back, okay? We get it back. And the next additional information, we have the warranty expense were accrued, and at year end, the actual payment is 60,000. 60,000. So we want to see you actually pay 60,000, but in accounting, how much? 100. Okay. So we want to add back this 100, deduct that actual payment 60. Is that clear? Because this expense must be accrued. You recognize 100 expense, but you actually only paid cash 60. So tax deduction 60, and accounting deducted from 100. So we add this 100 back, deduct that 60. Make sense? Okay. And what else? The insurance was prepaid by this amount 150. At year end, unused component with this prepaid insurance amounted to 75. Okay, so you paid 150. That's cash out. Okay, how much you actually recognize as the insurance expense? 75. Okay, do we know how do we do? So we actually paid 150, but we recognize the expense 75. So we add this 75 back, we deduct that 150. Because this is prepaid, right? Okay, prepaid means your cash out, but you didn't really use that much expense in accounting. That's why your expense recognition is less than what you have actually paid. Is that clear? Okay, and what else? Amounts received from sales, including those on credit terms. What does that mean? Sales revenue doesn't matter, right? Because accounting and tax recognize them simultaneously. Okay, so we don't need to adjust that. So yes, they said tax at the same time the sale is made. If you don't have this sentence, you would be able to do it as well, okay? Because sales revenue will be recognized simultaneously by accounting and tax, okay? In the same way, they treat it the same way, all right? Next, the plant is depreciated on a straight line over 4 years for accounting purpose, but over 3 years for taxation purpose. Which means accounting recognized depreciation expense should be less than tax purpose. Can you see that? Because you depreciate by 4 years, tax as 3 years. Okay, so how much depreciation expense you recognized? Over here, 75, right? And if we want to know the tax only about 3 years, we need to see the plant information here, right? So the plant original cost is 300, right? 300. We look at the financial position, so that's 300, okay? 300 over there. Where is the plant? Okay, it's not working over there. Okay, let me do that. So we have 300 over here, right? And its allowable deduction would be divided by 3. So 100 every year for tax purpose. Which means for depreciation expense, you deducted from accounting, which is 75. We add it back and we deduct the right amount for tax allowable amount, which is divided by 3 years, 100. Is that okay? What else we have? Okay, that's pretty much everything we discussed. Now look at this. Determine the taxable income for the year end of this year, right? Okay, starting point of this worksheet is called current tax worksheet. This is the very first step of getting your tax payable for current year. Okay, so this is the current tax worksheet. We always start with accounting profit, 250, which we get from the bottom, the previous income statement, right? This is the accounting profit before income tax. Then we always add the things, the revenues, the expenses. We add the expenses back to accounting, okay? When the expenses is recognized in accounting. Is that okay? So we add back the expenses that accounting deducted from its profit. Then we deduct the right amount that the tax allows you to deduct. Is that okay? And for revenue, we do the same. All right. So we have discussed the government grant. This has been included in this accounting profit figure, right? But we should deduct it from the accounting profit figure because tax says you don't have you don't need to pay tax on this type of revenue. Is that okay? So we deduct this revenue, and we have the expenses. So accounting has deducted 50,000 expenses from accounting, right? So this accounting figure actually deducted this expense. However, tax says, no, this expense you can't deduct it until you have cash paid for it. Okay, in current period, it didn't happen. So we get back this expense, this amount. Okay, so that's why we added back to accounting profit. And there is no cash payment for that, so we don't deduct anything. Okay, for this long service leave. For entertainment expense, this 10,000 actually deducted from accounting, right? But tax says, okay, this expense, you can't really deduct it permanently. So you add it back to accounting figure as well. Accounting profit as well. Any question? Oh, no.
It will be back soon.
Oh? Yeah, let's be patient.
Okay, yeah, good. Okay, so we get the entertainment expense, get it back to accounting profit. Is that okay? Any question, raise your hand, okay? I need your full attention because you shouldn't be wrong from the very first step. Otherwise, for the following step, you will get lost. Okay? Make sure you are with me all the time. All right? Without blinking your eyes. That's okay, you can blink your eyes. Maybe we can take some meditation during the process. I know this 2 hours are too long for you, but unfortunately, sorry. Anyway, let's move on. So we have the warranty expense. Again, this expense in accounting, we recognize 100, right? And we get it back to accounting profit. We add it back, but we want to know how much cash actually paid. Then deduct that cash payment. All right. So the cash payment for the warranty is 60. So we deduct 60. That will give us the proper amount that tax allows us to deduct. Is that okay? Then we have the accounting depreciation. We know that's by 4 years. Every year we deducted 75 from accounting. Now we add it back to accounting profit. And we deduct the tax allowable deduction. The tax allowable deduction is for 3 years. 300 original cost divided by 3, we get 100 every year deducted for the depreciation expense tax allowable amount. Is that okay? All right. Then we have insurance expense. Insurance expense, we paid cash. We look at the income statement. We have this 75 deducted from accounting profit. We add it back. Okay? Then we see how much we are allowed to deduct for taxable profit because we pay cash for. Okay? How much we paid cash for? Originally it's paid 150. So we deduct 150 from this accounting profit so that we get the taxable profit. Is that clear? Any question? Okay. So I'll repeat the process again. We start with accounting profit, then we add something like the expenses that shouldn't be deducted or that have been deducted from accounting profit. We add them back. Then we see what should be the actual figure, tax deductible. Then we deduct them from this figure. Then we get the taxable profit eventually. Okay, for your current year, this figure would be times the tax rate. You will get your current tax liability, current tax payable. Is that clear? All right. So now we got the taxable income 240 and the tax rate 30%, that's 72,000 would be your current tax liability. Okay? However, if we calculate the tax expense, because we do know for those transactions, some of them you may not pay tax now, but eventually that will be part of your tax expense, right? So we should be able, just based on the transaction, we understand if you have your tax expense, any temporary eventually doesn't matter because you either pay now or later. But we do have some permanent one, which will not have the effects of your any future results, right? Tax payment. Then if we just deduct the permanent one, which is not going to affect your taxable profit in the future, like the government grant, like the entertainment expense. So if you just based on the transaction you happen in this year, starting with the accounting profit, we less the permanently exempted revenue, we just plus the expenses that is permanently not allowed for deductible, we get them back. Actually, this would be your profit, right? This would be your accounting profit. And this figure is going to be 75,000. Can you see the difference between the current tax liability and your tax expense eventually based on the transaction 75,000? The difference between them, 3,000. Okay, 3,000. What happens to those 3,000? What happens to those 3,000? We defer them. We defer them. They are deferred to the future. Okay, so you will see the concept like deferred tax assets, deferred tax liability. Okay, we are going to touch on them in a minute. All right. Okay, then we have the tax effect accounting. Tax effect accounting, they basically have one method we deal with this. This method is called balance sheet method. Balance sheet method. Why we call them balance sheet method? Because basically it looks like just what we are doing for assets liability. Okay, accounting balance sheet, do we know how to do that? How are they going to be presented? We have assets, we have liability, right? That's the balance sheet accounting. For balance sheet method, we basically do very similar as what we have done for accounting balance sheet. We also have assets, we also have liability, but we call them tax-based assets, tax-based liability. So we have a concept called tax base. The tax base is just defined as the amount that is attributable to an asset or liability for tax purpose. It's very similar like the assets liability, but that's for tax purpose. That's a tax base. That's why we call them balance sheet method. I'm going to show you what is that, okay? So for that first of all, you know we have a concept called tax base. Then for the whole process, when we need to solve the problem, when we need to recognize, calculate, and do accounting for that deferred tax, we just see the 3,000 difference, right? When we are dealing with them, the steps you need to follow is always first determine the carrying amount. Is that easy? The carrying amount, you simply get them from the accounting statement. Okay, assets, liability, carrying amount, you copy the figures. Easy. Okay? And then you determine the tax basis. How? I'm going to talk soon, okay, in a minute. All right. So then determine the tax base. Then if carrying amount is different from tax base, we will have difference, right? We need to determine whether or not what kind of temporary differences they are. Some difference, you need to pay tax later. Some difference, you will save tax, right? Then we will have another name called the deductible, temporary deductible difference, taxable difference, temporary taxable difference, or assessable difference, okay? So that we will need to decide that, and then we determine the closing balance of the deferred tax. So based on this figure, you should be able to know your deferred tax assets or liability. Based on this part, sometimes students get confused. We know the difference. That difference It's purely coming from the accounting and taxable profits difference, okay? Based on that profits, based on that difference, you times your tax rate, you get deferred tax rate, deferred tax assets, or deferred tax liability. Okay? You determine that deferred tax assets or liability. If there is any other movement regarding deferred tax asset, deferred tax liability, you need to consider them as well. And you need to consider at the beginning how much your tax assets, deferred tax assets, deferred tax liabilities are at the beginning. Then you have the closing balance. You need to have, because based on all the calculation, you need to have some closing balance like that. And you consider the beginning, you can consider the movement during the year, then you know how much you should recognize for the year. Okay? So that's basically the whole process. All right? Yeah, then eventually you determine the deferred tax adjustment entries. Okay, like I said, carrying amount, nothing to talk about. So just simply, for example, the account receivable would be the balance account receivable less the allowance for doubtful debt. So the first step, we need to determine the carrying amount. That's very simple. For fixed assets, just the original cost less the depreciation, accumulated depreciation, that will be your carrying amount. So there is no difficulties in identifying carrying amount at all. Do we agree? Yes. Knock your head heavily. Show 100% confidence, right? Carrying amount, no problem at all. Okay? Okay, thanks. Then tax base. Tax base. I'll interpret this way. When you see this one, you still always confused. But I'll show you this way, which hopefully will help you to memorize them. Okay? So tax base for an asset, tax base for an liability would be different. Just like assets and liability are different things, okay? So the tax base for them are different. The formula for calculating tax base for assets, tax base for liability, slightly different. That's why you always get confused. They are not entirely different, they're slightly different. They all based on the carrying amount. Let me see if I have that slide in this. Okay, not yet here. Okay. Okay. So they all based on carrying amount. So tax base for assets, you will have the carrying amount from accounting statement, right? If you have that carrying amount from accounting statement, I assume you can always copy that figure correctly over here, okay? So you have the carrying amount. Then there are, when you do the tax, you do some adjustment, which when you want to have the tax base, one thing is called future deductible amount. One thing is called future assessable amount. This one sometimes is also called taxable. Okay, they can be interchangeably used. Okay, so that's not a problem, I hope. So future deductible, future assessable. Think about it from from the economic benefits perspective. If you have an asset, based on that asset, in future, you will get some amount, some deductible amount based on that assets, which means in future you will save some tax. Okay, you don't need to pay tax on part of that. Do you think that will increase your economic benefit or decrease? So you have the asset, and that asset in future will get you some tax deduction. And that tax deduction from the economic benefits perspective, do you think that will add your economic benefits or get rid of part of your economic benefits? From the assets perspective, if you have deductible amount, basically you save tax, right? You treat it as the economic benefits in. Is it okay? That's why for tax-based assets, we add the future deductible amount. Okay? And for future assessable amount, you can also call it future taxable amount,
for this amount, if you, having this assets, in future you will have to pay some tax on that. You basically treated the value decreased, right? That's why for an asset, we add this FDA, future deductible amount, we less this future assessable amount. All right, so that's for the assets perspective. You always think about the economic benefits from that. So we adjust the tax base based on the from this accounting carrying amount. Then we add future deductible amount because we believe future deductible amount is kind of economic benefits you are going to have. And future assessable amount is a tax you are going to pay that deduct the value of the economic benefits. All right, so we add future FDA, we less FAA. Okay? And future assessable amount, what is the future deductible amount, future assessable amount? Think about the depreciation. Future deductible amount is about how much you are going to be deducted for tax payment, right? And future assessable amount is about the how much you will be paying tax on that, right? So that's the future assessable amount. Think about most of the assets, their future assessable amount equals to their carrying amount. Most of the assets, they will have this feature. Because think about the asset. If you can sell it, so the asset is worth 100,000, and if you sell it, you have that 100,000, right? So that at most, future assessment, sometimes you think, okay, if I bring economic benefits for a huge amount from that asset, then I will need to pay tax for that amount, right? If you get some gains, you will need to pay tax for that. If you need to pay tax for that, that could be more than your carrying amount, right? Could be more than your tax, your carrying amount. The asset is worth of 100,000, but this asset produces all the products and they could be sold for 200,000, right? And you need to pay the sales revenue for the 200,000, right? So that will become future assessable, right? However, the tax says at most the future assessable amount would be equal to their carrying amount. You don't assume you have more than that, okay? For some of the assets, their carrying amount would be just equal to their tax base, like cash, okay? Like inventory, like the accrued revenue, if the revenue is not accessible, so that will carrying amount will equal to their tax base. And if the depreciable assets, tax and accounting rates are the same, they don't have 3 year, 4 year, they all have 4 years, then your tax base would just equal to carrying amount, okay? If the carrying amount is different from the tax base, there would be a temporary difference generated. If the carrying amount is greater than tax base, then we would have the taxable temporary difference. You don't really need to force yourself to memorize this sentence. You just remember what we have from this equation. What we have for assets, tax base equals carrying amount plus deductible amount, because you save tax, right? Less assessable amount, right? Then you need to pay tax on that. That's your obligation. All right? So if you rearrange it, so carrying amount less tax base would just equal to future assessable amount less future deductible amount. Okay, we just rearrange it. If the left-hand side is greater than 0, it must be because the right-hand side greater than 0. Then future assessable amount is greater than future deductible amount. Okay? If you have more future assessable amount, which means your taxable payment, you will have some tax, right? That's actually coming from, this one would be recognized as the taxable temporary difference. Okay, taxable temporary difference. If this side is less than zero, carrying amount is less than tax base, then you would have a deductible temporary difference. It must be because the future assessable amount is less than future deductible amount. Then you have this one, right? So you will have deductible temporary difference. If you have deductible temporary difference, do you think you have an asset or you have a liability? If you have a deductible temporary difference, are you going to have an asset or a liability? Assets, very good. Because if you have taxable, you have deductible difference currently, which means in future you are going to be the tax will be deducted, right? Then you treat it as an asset. Is that okay? So eventually, if you get all the assets and you calculate the difference, and for all your future deductible, if this you will see eventually, I'll show you the format of the worksheet later, okay? You would have two columns. One is called the temporary deductible difference. One is called the temporary taxable difference, okay? And if you add up all these deductible difference, you will get the sum of the deductible difference. That difference times 30%, you will get deferred tax assets. The taxable temporary difference, because we are doing line by line for each item. Okay? And the taxable difference, you add them up, you will get the sum of the taxable temporary difference. And that one will generate some obligation in future. You need to pay tax on that. Then you will have deferred tax liability. This is one of the key understandings. Some students just get confused by the difference between the temporary differences and assets liability. Okay? The difference between the temporary differences and the assets and liability is the tax rate. Does it make sense? I'll briefly show you this format, then you know what I'm talking about, okay? Okay, here. So you see, for each, okay, here, I want you to understand the whole picture of what I'm talking and where are we now, okay? So the whole picture is this income tax worksheet. And we are doing the balance sheet method. So for each asset, each liability, each item of assets, each item of liability, we know their carrying amount. For example, cash, we know the carrying amount. Then we see their future deductible amount, future taxable amount. Then we calculate the tax base. Okay? If there is any difference between carrying amount and tax base, that would be a difference, right? That difference, if that's a temporary difference, we will determine whether the taxable temporary difference or the deductible temporary difference. For example, this one, you don't know how to do that yet, but I'll show you. If they have the taxable temporary difference, we will note down as a taxable temporary difference. And for each item, we have this. Then we add them up. The temporal difference would be this figure, taxable. And deductible difference for each item, then we add them up. That's the total deductible temporary difference. For deductible ones, yes, deductible temporary difference will generate the deferred tax assets. You see, this is deferred tax assets, okay? And for the taxable temporary difference, eventually we will have liability because this is difference, but that's taxable in future. Then you need to pay them. Then you get deferred tax liability. Eventually, the whole worksheet would look like this, okay? That is on page 34, I guess, 34 or 35. So you know where we are. We are currently discussing future deductible amount and future assessable amount, right? Then we want to see the difference between, we want to see how do we determine the two differences from the balance sheet method. Are we okay? So we calculate the tax base for the assets, then we want to know whether there is a taxable temporary difference or whether there is a deductible temporary difference. This is for assets. So you know where we are, right? Then the tax base for liability. Again, let's start with the carrying amount. This is the liabilities carrying amount. And for this liability, think about if you have future assessable amount. If you have future assessable amount, then your future assessable amount, is it going to be increasing your liability or decreasing your liability? Increasing, right? If you have future assessable amount, which means you need to pay tax in future, then that one should be added to your liability. Okay? Remember, if for assets, we deduct it, right? But for liability, because that increase your liability, so when you calculate the tax base for the liability, you add it. Okay? And future deductible amount, you will get some liability decreased, right? Future deduct because you don't need to pay that much tax. Then you save some tax, then you don't need to pay that. Your obligation is reduced. So that's deducted from the liability tax base. Clear? So this equation is just the sum of this FAA, the sum of FDA is different from the tax base for assets. This is for liability. Okay? Again, if you rearrange it, you will get if the carrying amount for the liability, if carrying amount is greater than tax base, you would have a deductible temporary difference. If the carrying amount is less than tax base, you would have a taxable temporary difference, because it must be coming, if the carrying amount is less than tax base, it must be coming from this FDA less than the FAA. You can just rearrange the equation, you will get that. Okay, so that will be the taxable temporary difference. All right, so I will discuss them in the example. Okay, determine the tax base for prepaid insurance. So the example 3 will be used through the whole lecture. In the later one, we still use that. Okay, so this determine the tax base for prepaid insurance. Prepaid insurance plan. What are they? Are they assets or liability? They are assets. The equation for assets, carrying amount plus temporary deductible, right? Less future deductible, less future assessable. Yes, plus future deductible, because future deductibles will give you the economic benefits from the assets perspective, right? And future assessable should be deducted, because that will reduce that value. Okay, that's for assets. Provision and warranty expense, those are treated as the liability. So you use that as the liabilities formula. That will be carrying amount plus future assessable amount, because future assessable amount will be your obligation to pay, right? Less future deductible amount, because that one will reduce your liability. Okay, so for prepaid insurance, if you look at the carrying amount from the financial statements, that will be 75. Okay, and future deductible amount for assets, for this assets, that's 0, because you don't have anything like for account receivable, you may have this bad debt provision, right? But for this one, you don't have any future deductible amount. But for future assessable amount, if you have this insurance, in future, it may bring more economic benefits. However, at most, you can recognize it as the carrying amount. Okay, at most, that's the carrying amount. For most of the assets, the future assessable amount will be just equal to the carrying amount. So the tax base would be 0. Tax base. If you calculate, then the tax base would be 0. Then, can you see there is a difference between carrying amount and tax base? 17.5. Okay? Is that there is a temporary difference? What is that difference? It's coming from the future assessable amount, right? That will be the taxable temporary difference. Very good. And the plant, we have carrying amount and future assessable amount, future deductible amount. Future assessable amount will be equal to the carrying amount, 225, and future deductible amount. How do we get this future deductible amount? Think about this plant. Having this plant, how can that generate some deductible tax deduction? How can that generate tax deduction? Having this plant. I heard the word depreciation. Depreciation. When you have depreciation, in future you will save that tax, right? Because depreciation expense is going to be deductible, right? So you will save your tax. Then the future deductible amount for that. However, remember, this tax allowed deduction will be only remain for 200 because you have 1 year depreciation in previous year, right? Now in future, how much you can deduct it from the tax? In total 3 years, right? Now you have 2 years remained. Each year depreciation 100, 2 year 200. So your future deductible amount will be 200. Okay, so that is the way you calculate it. And provision for warranty expense. We have the carrying amount 40, and this is the liability. This is the liability. Most of the liability items, their future assessable amount will be 0. Because for liability, normally you don't pay tax on the liability in future, right? So the future deductible amount would be also 40,000. Why is that? When you have provision for insurance expense, you recognize insurance expense, right? Insurance expense provision, liability increased when you do this accrual accounting, right? You have insurance expense, you have provision, recognize liability, right? However, this expense, you are not allowed to deduct for current period. Is that okay? You're only allowed to deduct that in the future, when that expense is actually paid. Is that clear? So your future deductible amount at most equal to the provision for the carrying amount. Are we okay? Reflect a little bit, because think about future deductible amount from this assets or liability. What could be deducted in future? This expense you recognize in accounting. When you have this provision for warranty expense, you have the expense in current accounting profit. Is that okay? But until you paid, you will not have that deduction. But when can you that deduction? In future. Is that okay? So in future, you will have the future deductible amount as this carrying amount. Provision for long service leave expense, the same way as we get for the warranty expense. The carrying amount and the future assessable amount for liability, most of them equal 0. And future deductible amount, 50,000. Okay? Because this expense, you haven't got it deducted from your tax for this period, you're going to have them in future. Okay? When you pay cash. Okay, let's make a judgment on the things we have discussed. So for prepayment, we have suppose you have this item, prepayment 3,000. You calculate the carrying amount is 3,000. We'll see for this prepayment, do we have future deductible amount or do we have future assessable amount? For this prepayment, your future deductible amount would be 0 because you don't have any deductible things from that, right? And this is the asset. The future assessable amount will be equal to the carrying amount. Okay? And for interest receivable, this is also an asset. So if you look at here, this is all about assets. Assets carrying amount less future assessable amount plus future deductible amount, you get tax base. And from here, you get the liability, which would be carrying amount plus future assessable amount less future deductible amount. Then you get the tax base. Okay? So when you have the whole statement, look at the items, assets, liability separately. Okay? So when we have a look at the interest receivable, 1,000. The carrying amount is 1,000, right? And future deductible amount from this receivable, we don't have any, 0. However, if you may think this receivable, you probably will not receive in future. You may have some provision like the bad debt. You will have deductible amount because that expense you can deduct from tax. Is that clear? Just see what could you deduct from the tax purpose, tax profit. That will be your future deductible amount. And for most of the assets, future assessable amount will be just equal to your carrying amount. Okay? For the plant, we have the cost 10,000, accumulated depreciation 4,600. Can we say how much the carrying amount will be? The difference between the initial cost and the accumulated depreciation carrying amount. We have no problem with that, right? And for this assets, future assessable amount at most equals to this asset value. It could generate more revenue than its carrying amount. Would you agree? So the carrying amount is 5,400, but you may have some products produced and the sales revenue would be 10,000. But at most, you recognize it as 5,400. And remember, for most of assets, future assessable amount equals to the carrying amount. And future deductible amount, do we have future deductible amount for this one? Having this asset, do you have future deductible amount? Depreciation. Think about depreciation. And how much is remained, you can deduct your tax. Think about these assets. If the tax allowed depreciation has been accumulated for 6,500, so for tax purpose, your depreciation only remained 3,500. Is that clear? So you only have 3,500 remain. That will be your future. Future deductible. No, business. Account receivable, you have 50,000. Your future assessable amount for most of the receivables, your future assessable amount. Look at the interest receivable. Your future assessable amount is 1,000, equal to the carrying amount, right? Because when you have the receivable, you recognize the revenue. However, you haven't received cash. But for account receivable, that's different. Because account receivable coming from sales revenue. From sales revenue, the revenue has been recognized. You have to pay tax for this period, for this revenue as well. Accounting recognized revenue and tax recognized the revenue, you pay tax. You don't need to pay tax for this account receivable in future. That's why your future assessable amount is 0. Future deductible amount, normally the assets won't have that, but for this account receivable, because it has allowance for that. That allowance, when it actually happens, will be deducted from tax. Is that okay? Just 2,000. That will be. If there is no such bad debt allowance, this could be just 0. Is it okay? Then we determine the tax base. All right. Okay, then I'll just give you one example. For account payable, similarly, in future, you don't have the future assessable amount or future deductible amount because that's all recognized in current period, okay? And for this annual leave liability, If you have 3,900, this is a liability. And for most of liability, future deductible amount will just equal to this carrying amount. Okay? Then that's the future accessible amount. For most of liability, they don't generate. For liability, they don't generate future accessible amount normally. So this will be just 0. Okay? And we have goodwill. Like we discussed, the goodwill, there is no deductible amount. No matter you have impairment loss or whatsoever, this is not allowed to deduct it from the tax. Okay? So the future deductible amount will be 0. And future accessible amount will be just based on how much this goodwill would generate. That would be 35,000. Okay? One example for a land. I haven't listed in those items, but for this, if you have the example here, I will not give you time to type back, but I'll discuss it here. See, if this land original cost is 100,000, now revalued to 120, what are the future deductible and future taxable amount? If you can type, it's also good. The land doesn't have depreciation, right? But it does have the revaluation. If it doesn't have the revaluation, think about the land. If you sell it in future, if you sell it, then suppose you have capital gain, right? Suppose you have 120, you purchased it 100, you sold it 120, right? Then you will pay tax. Are you going to pay tax? Yes. Do you have any deduction from that? You have original cost, right? Original cost would be 100. When you sell it, your revenue will be 120, right? So you sell it 120, you need to pay tax on that. Okay? And when you sell it, you pay 120. However, that has the cost. The cost is 100. So now can you tell me which is the future taxable amount, future deductible amount? Which answer would be? A. Future deductible amount will be the cost, 100. And future accessible amount will be the revenue you can sell, 120. Okay? Good. Somebody got it. 100%. Very good. Impressed. Okay. Yes, like I discussed, there could be two types of difference, taxable temporary difference and deductible temporary difference. I have discussed through the example. Then you review the slides to see conceptually if you understand them, all right? And then we will have determined the deferred tax assets and deferred tax liability. Again, like I discussed, here, we eventually need to determine deferred tax assets or deferred tax liabilities so that we can do the accounting, we can put them in the journal entry, then they will show in the financial statements. Okay? For the assets, yes, deferred tax liability arises when the carrying amount is greater than the tax base, which is the future accessible amount is greater than this future deductible amount. Future accessible amount is greater than future deductible amount. You need to pay tax, then you have liability. Is that reasonable? Understandable? Yes. You don't laugh. Yes. So remember, when you recognize deferred tax assets, it also needs to meet some criteria, like what we have calculated. We may have the
future deductible amount more than the future assessable amount, so we will have the deferred tax assets, right? However, when you recognize deferred tax asset, you need to make sure in future you will have enough operating profit to use this deferred tax assets. If you believe your company is going to have loss every year, you won't have income tax expense, then you don't recognize the deferred tax assets. This is for deferred tax asset. For deferred tax liability, whenever you have it, you recognize it. Again, this is more conservative. Can you see that? We recognize assets with more strict criteria, recognize liability with the okay. Okay, as long as you have it, then you recognize it. The journal entry would be very simple. If you have deferred tax assets, you will just use that. You can treat it. You either pay cash for your expense, right? Income tax expense, or you use your assets to cover that. So when you have deferred tax assets, you use deferred tax assets to cover that income tax expense. All right, so debit deferred tax assets, credit income tax expense. Liability would be always in the opposite direction, right? Because your liability will increase your income tax expense. All right. So the income tax worksheet. I've shown you here. So we always have these items here. Always have this item here. I'll change to a different color. Would that be easier? No. Okay, here. All right. Then we need to know the carrying amount. Then we need to know the tax base. Then between the difference, for this difference, we need to determine whether we have taxable temporary difference or deductible temporary difference. Okay, so for each of the items, how do we get the tax base? We get from this equation. Okay, we determine future taxable amount, future deductible amount, then we get tax base. All right, if there isn't any difference, we need to determine whether that's the taxable difference or deductible difference. And the taxable difference, you will have future liability. You will have future liability. For the deductible difference, you will have the total deductible difference times 30%, you will have the assets. Because if you have deductible, which means in future you can save your tax. All right, so this is the whole worksheet. And if you can get that worksheet, from this worksheet, can we see we actually get the deferred tax liability this much, deferred tax assets this much, and when you calculate your income tax expense, you just use that income tax expense to get you use your deferred tax assets or deferred tax liability to cover that income expense. This journal entry could be in 2 steps. You could have deferred tax assets and income tax expense. You can always have those abbreviations in your exam if you wish. So that will be 27 and 27 credit. And again, for liability, you can have debit income tax expense 30 and deferred credit, deferred tax liability 30. And if you combine them, you will just get this. You can do 2 steps or 1 combined. That's fine. All right. If you have tax range change, again, think about what you have in deferred tax assets. Suppose you have this deferred tax assets and deferred tax liability in your account. How did you get this figure in previous year? This figure must be based on that year's tax rate, right? You have a temporary difference times the tax rate, you get deferred tax assets, right? That's what we get. And now the tax rate change. You need to apply the new tax rate for that temporary difference. So what we do, we will get this deferred tax assets 500 divided by previous year's tax rate. then you get that temporary difference. Is that okay? And that temporary total difference times current year's tax rate give you your current deferred tax assets. Okay? And that deferred tax assets must be different from what you have got that in the statement, right? And that difference needs to be offset your income tax expense. Okay? So, yes, we do this calculation divided by 30 times 25%, then we get the change should be this much. Okay? And for this deferred tax liability, we do the same, divided by the tax rate times the 25% is the new tax rate. Then we get the changes. Okay, the changes should be this much. And how do we account for them? We just decrease the liability and increase the assets because we need to increase the assets, right? We need to decrease the assets and decrease the liability because the tax rate decreased, right? We decrease both of them, and you could have separate the control account will be income tax expense.